Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenborg.
Because it's not how much you make in the markets, it's how much of that you can keep.
Danger, 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 Will Robinson. It's a narrow stock market warning, folks. We've been talking about this for months, and all of a sudden, all the articles are coming out in spades, left and right, all over the place. Is NVIDIA too high? Do you need to sell? Is this a narrow market? Is it not a narrow market? Now, folks, I've got a bunch of articles in the show notes. You can go look at them. One is why concentrated stock positions is a loser's game by Larry Swedroe. So you should have emerging markets, you should have international, you should have small caps, you should have things that are going down to offset the things that are going up. Or in another article, does NVIDIA surge reveal the pitfall of passive investing? In other words, you own a bunch of mediocre stuff. Is that really a pitfall? Now, there's a whole plethora of new ETFs, active ETFs based on relative strength and active management. Kind of like the Bitcoin ETFs a few months ago. Remember, all the Bitcoin was a rage and all the new Bitcoin. So all the people that create these ETFs, they always go where the action is right then. The problem is by the time they get all those ETFs issued and out there, a lot of times they're kind of late in the game. Anyway, now you're getting a whole surge of these active invest ETFs that are trying to go for this narrow market. Now, here's the question. Is it true that concentrated positions is exposing the diversification fallacy, whatever, or is diversification the way to go? You see, folks, I believe it's a loser's game, whether you're diversified or not, whether you're narrow or not, if you're losing money consistently over the long term, or if you're making very poor returns. It's a loser's game if it's not working. If it's working and you're managing risk effectively, then I think you're okay, regardless of the strategy. So look, you must take risk, and you got to take risk in consideration whether your strategy is diversified or narrow. My question is whether it's working is how big are your drawdowns? How much do you decline? Do you just decline right with the market and you're just riding the market? Or are you controlling your losses? So again, diversified or not, if you're making decent money, it's okay. Do you have a sleep stop? That's the question. Kind of like a sleep put, not a sleeping pill, a sleep put where you can sleep at night being invested in this market. So I always want to have an exit plan in advance. So I want to plan for the worst and hope for the best, right? Now, that's why we don't forecast. I call it the guessing game, AKA forecasting, right? And we've got a bunch of articles in, like I said, in the show notes. One is concentrated position, loser's game. Everything with NVIDIA is all good news in the near term. NVIDIA's surge reveals the pitfalls of passive investing. And my favorite, Harry Dent, the broken clock, market should expect a bigger crash than 2008. Okay? Then there's also one about real estate investors getting wiped out based on bets by Wall Street. They were doing a bunch of real estate paper this last few years, and we've talked about that as well. So in any event, and there's another one talking about India is one of our favorite emerging market stories. So folks, if you are going to have that diversification theme, so you are going to invest abroad, should you just own all the emerging markets? No, a lot of them are going down. They're getting crushed. India's doing pretty well though. So if you're going to have diversification, go other places, how can you find the places that are the best? If you want to have a little more diversification, fine, but you should use some relative strength and some metrics so that you know what exactly is happening, how you can manage risk. I don't mind taking risk. I just want to manage my risk. So before we head right into the markets, because I'm going to ask the guys, we're going to have a little bit different show today. Rather than going to each one for their segments or stuff, we're going to have kind of a round table discussion, okay? And we're going to talk about the markets and get their thoughts on the markets, because this is on everybody's mind. Look, I don't want to sound like I'm beating a dead horse. We've been talking about this for a couple months, and now all of a sudden the market and Wall Street and everybody else has caught up to us, and now they're all talking about, is this market too narrow? Is NVIDIA unsustainable, et cetera? Now, on the Zach, can you show the chart on the chart there? Ted has put up a NVIDIA chart relative to Apple and Microsoft. So for Apple and Microsoft to go from $1 trillion to $2 trillion, it took Apple 749 days. It took Microsoft 786 days. It took NVIDIA 262 days, about a third of the time. Then from 2 trillion to 3 trillion, it took over 1,000 days for Apple, almost 1,945 days for Microsoft, and only 96 days for NVIDIA. That's why everybody's so worried. Is Icarus flying too close to the sun? Everybody is nervous that this is unsustainable. And theoretically, think about it. If NVIDIA is $3 trillion, and it goes to 4 trillion or even 5 trillion in less than a year, in just 90 days or 100, to keep that same growth rate, you've got to double in the same amount of time or less for that same growth rate. Well, in a couple of years, you pretty much own everything. You swallow everything else up. You're squeezing out everybody. So the question is NVIDIA's growth rate sustainable? But more importantly, how will the market perceive that? Because look, let's be honest, international is struggling, okay? Even small caps, although they may be starting to heat up, and mid caps have been struggling. It's been a very narrow market with large caps at the top, and specifically the semis and AI and the chips, right? You take that group away, and hell, we're probably negative on the year. These stocks have really been firming up the market. And with that, I'm going to go to a mailbag. I'm not going to read all the mailbags, but I want to read this one because this is so apropos. So in the last week or two, I've gotten a 3 or 4 or 5 clients, which if I got 4 or 5 clients reaching out, that means 50 are thinking the same thing, and they're scared. Hey, how are you going to protect the NVIDIA profits? What are you going to do? How are we going to, how is this sustainable? And they're scared. Then on the other side of the fence, I got people going, man, I want all in. Okay. Now, this is on 6/18. This was actually last Friday, but I'd gotten it right when we were doing the show. I just missed it to do the show. We actually did the show early last week. So it was, I guess it was Tuesday, I think, Zach. And so I got this last week, but I didn't get to read it. Hey, Dan, hope you're well. No, you guys are the experts, but I'm thinking about purchasing NVIDIA since the split. I only have about 50% of my portfolios in cash right now. Thought about buying 50 or 100 shares this week. So he looks at his portfolio. He's got half cash. So he's thinking he's only half as risky as the market. And I want to buy 50 or 100 shares. Okay? Me. CW, we have very meticulous rules regarding position sizing so you don't get hammered. When we originally purchased NVIDIA for clients due to its high price per share pre-split, you didn't get because even one share would have been too big for a starter position size. Now that it's split, it's available and suitable for smaller accounts. Now, let's see. Now that it is split, it is way too expended at the moment. That doesn't mean the stock won't go up. It just means you're taking extra risk, okay? Right now, there are other stocks that are more timely. NVIDIA is the market leader and one of our favorite and largest stock positions, but we have to be mathematical about it and not simply guessing based on feeling or emotions, especially FOMO, fear of missing out. Chasing may work occasionally, but more often than not, it causes you to lose money And worse, it affects your psyche for the next go round of trades going forward. We want to focus on the long game and not try to get rich quick. You also have to position size accordingly to manage risk. How did you come up with the 50 or 100 shares? Question mark. 50 shares would be approximately 13.5% of your portfolio, and 100 shares would be 27%. Thus, you either have to be you'll either be really right or really wrong, akin to playing a hand of blackjack. We don't gamble. And in addition, regulators be all over us for putting a client in one stock over 20%. Now, when NVIDIA comes back into a buy zone after a pullback, we would purchase NVIDIA then if it is the best use for your money and our money. If you want to be really aggressive, we can help you split off a chunk of your account, say so-and-so amount, and we can put it on the retail side, and you could buy NVIDIA and let it ride. We cannot do that for you. We can't manage risk. We're not going to do it. By the way, I forgot to mention, you have 30% position in, this is a week ago, we've trimmed this down since then. I forgot to mention you have a 30% position in SSO, a double S&P. Therefore, you have 30% more invested than you think, and because some of these stocks have a higher beta, your exposure is actually above 1 or more than 100% invested than the S&P. So even though he's saying he's got 50% cash, he's actually more aggressive, this was last Tuesday, than the S&P 500. What I'm saying is even though you have a large cash position, you are really fully invested relative to the S&P. So, folks, that's why you've got to have rules. Otherwise, you're just guessing. You're just forecasting. He's assuming NVIDIA is going to go up. Right now, the market is acting pretty bullish, although the last couple of days got a little bit choppy, a little bit scary, but they've held up and firmed up. So right now, we could be in a moment of sideways consolidation, and then we move higher. Alternatively, if NVIDIA and some of these big tech stocks, the AI tech stocks, start to give up the go, if they start going down, then you're really going to have some problems in the market. That would be very bearish because, like I said, there's a handful, 8, 10, 12 stocks that are holding up the markets. So without further ado, I want to go directly to the markets first. I want to go straight to the guys. Now, Don is out this week. He's at a very nice family reunion, enjoying himself. He's still looking at the markets. He can't help himself. He's been texting all morning. But in any event, so with that, let's go to Ted first. Ted, let's talk about, I want to see where you think the markets are in time and space and how you're going to handle it. And then I know that you got some pretty good meeting of the minds and you kind of are in sync with Connor. So don't take all the thunder. Leave some leftovers for Connor to talk about. So Ted, what do you see?
Yeah. So overall, I mean, as you can see, look at the S&P 500 chart, and then we look at a NASDAQ or just QQQ chart. We recently broke out of this base and we're just still trending above the 8 EMA in a strong trend. Yesterday, with the semis pulling back and exhibiting bearish outside reversals, the markets did as well. So we notched a distribution day in the S&P and then a distribution day in the Qs. But today we are finding support at the 8. So trend continues, but that's just the first indication of maybe potential exhaustion or just some profit taking. Overall, there is a thought that breadth is deteriorating, and we've been pointing that out. I want to borrow a chart from Tom McClellan. He's a really famous technician, and just pointing out in this market, we are seeing advanced decline line kind of bearish diverge with the index. And I just wanted to point out a Dow chart from the COVID crash. This is just one example, and there are many examples. The advanced decline line peaked on May 14th, 2028, but the markets didn't top until a year later. So all of this worry about breadth deteriorating now, specifically with the advanced decline line, could be an indication that we might find a top in the future, but it's not an exact timing indicator, and you shouldn't be too worried about that We should be focusing on price first. Market leaders, let's just talk about NVIDIA quickly, and then I'll let Connor give some of his thoughts. This is looking we saw a smooth uptrend after this base breakout on the earnings gap up on 455% year over year growth. But we recently had a gap up and then a bearish engulfing, and we followed through today, but found support with buyers and reclaimed the 8 so far. But the introduction of volatility just signals, to me at least, that we probably need some sideways on NVIDIA.
Okay, Ted, can I ask you, I want you to explain to the listeners, though, you threw out a term there. And look, we've got a lot of stock nerds following this show, but we also have some retail investors. You said a distribution day. Would you explain what a distribution day is? That's number one. And two, why that's important, telling you to signal maybe a breakdown in the markets when you get a certain amount of distribution days within a short time period. What does that mean?
Yep. A distribution day essentially just indicates that institutions are offloading their shares, either taking profits or selling into the markets. And it's defined by a down day greater than 20 to 30 basis points with an increased day in volume above the previous day's volume. So as you can see, this day we traded 38,470,600 shares. The previous day we traded about 35.5 million. And because we closed at the lows above that 0.2% level with an increased volume, that is what a distribution day is. And then for the other example.
Yeah, so institutional selling on high volume.
Yeah.
Got it.
Exactly. It just signals institutional selling.
Connor, we heard what Ted's thoughts are. What are your thoughts? Do you concur, or what are you looking at?
Yeah, I think Ted covered it pretty good. Kind of my thoughts on the market right now is, like Ted mentioned, the NASDAQ's around 9% extended from the 50-day. And historically speaking, when you go back and look at a chart of the NASDAQ, and if you plot on the chart when the NASDAQ gets that extended, the market often pulls back. It's not a certainty, but it's a good reference point. And then once the NASDAQ gets that extended from the 50-day, most of your tech leaders are long gone, and you should have been positioned in them before. So a scenario that I've been watching out for, thinking, is that, we potentially start to get rotation into other sectors. The Dow Jones outperformed yesterday, and then you had sectors like biotech, real estate, and some of those that outperformed. As we know, semiconductors pulled back hard yesterday. So I'm watching a few other sectors to see if they start to get some rotation into them. And I think that would set the stage up for another leg higher in the market. Other sectors get money flow. NASDAQ takes a rest, NVIDIA's, the Microns, the Avgos, those type of stocks, if they can go sideways and set up another base while other sectors outperform, I think that'd be the Goldilocks scenario. But for now, today, we're seeing strong bounces from Micron, SMCI. They're all bouncing off their shorter term averages today. So that's positive to see. And Micron reports earnings in 8 days, so that will be a big tell. But other than that, yesterday, as of now, just looks like it was a pretty nasty flush. And as we know, in steep uptrends, you can get these quick flushes to the 21-day or the 8 EMA, and they sometimes can be buying opportunities. So really just monitoring other sectors in the market right now. I want to see the NASDAQ and the S&P hold above the 21-day. And I think, if the NASDAQ got down to that 21-day, that could be a good opportunity given how bad the breadth is. And I mentioned it before, but, percent of stocks above the 20-day for the NASDAQ's at like 20%. So that speaks volume to the narrow market that we've been in. So yeah, just continuing to watch how some of the leaders hold up, and if any of these other sectors can move higher.
Okay, so what would be your big tell that it is not just a pullback to the 21 or the 8 EMA, obviously, if it breaks those, but what would be your big tell that it's turning into not only just a mild pullback, but it may be headed for a correction or even worse? In other words, how do you know you really got to get defensive?
Yeah, so first, right, like you just mentioned with the indexes, if they broke, but also if the leaders started to break down hard. NVIDIA had a pretty big outside reversal yesterday, but it's bouncing back today, so it's fine as of now. But if really started to see the stocks that have moved this market higher start to roll over, and then another thing would be if the whole market's getting crushed, because a lot of times we can see some sectors take a rest and some outperform. But if we started to see broad selling everywhere in the market, that would definitely be some red flags.
Okay. Ted, I want to ask you that question. What are your signals that you got to really get defensive?
So from an index's perspective, we just talked about distribution day. If we start seeing a cluster of distribution days, for example, back here in that March, just this pullback, we started having a few number of distribution days over the course of 2 or 3 weeks. I think we had 5 to 6, for example. Just eyeballing it, this was one here. As you can see, volume was higher than the day before. This was another one. Volume was higher than the day before, down on 0.72%. This was another one. And this was an outside reversal, kind of like we had yesterday as well, down 1.23%. So if we start seeing just a proliferation of these distribution days on the main indexes, the S&P and the NASDAQ, and like Connor said, if we start seeing the main leaders like NVIDIA, CrowdStrike, SMCI, the semis start deteriorating and breaking key moving averages, that would kind of be a red flag for me. That might be more than just a pullback to moving average, and we might need more time to base, having these three waves down.
Yeah,
back there.
And so currently, what they're saying is right now it looks like it may be consolidating sideways, and they're waiting to see whether it's going to break down or move higher to the upside. So right now we're kind of holding on new buying. We may pick one individual stock or two that looks really, really good, but we're kind of pausing on new buying till we see how this shakes out. Is that kind of an accurate statement, Ted?
Exactly. And kind of to summarize it or sum it up, we're always just evaluating every day and every week the health and breadth of the leadership. And that is our number one, I guess, if you want to call it, indicator of the health of the markets. It's what are the leaders doing across at least a few sectors, but ideally many sectors, 5, 6 plus sectors, all acting well. And when a proliferation of those stocks deteriorate, that is even more accurate to us than the indexes. But if that is combined with distribution days on the indexes and the main indexes and breaking key moving averages, then that to me would be a sign of worry.
All right. Now, we've got a special guest today. We've got Alex Koutoudis, aka Alex the Greek. Actually, should be the Greeks because he's also an option specialist. But we've got Alex on, and because Don is out, so I thought we'd bring Alex on and let him talk. Alex, I want to get your thoughts on the market and see if your thoughts are dovetailing with what these guys are saying.
Yeah. As far as the indicators go, I don't have anything negative to say on what they said. I agree 100%. And one thing I would add is if I'm making money, if I stop making money and keep chewing up my account, then that's probably a sign too that the market's turning down. So I keep an eye on my equity curve as well as the market, because usually they go together and they'll slope up in the same channel. So right now I'm making money and I'm pretty bullish. A lot of people on Twitter and the news seem pretty scared, and that's a good sign to me, because I hate to be mean, but they don't know what they're talking about, but we do. So I use it as a contrarian indicator when I see people on Twitter saying we're going to crash and this is the 99 bubble. I can't, that doesn't make any sense. Like in the 99, we didn't have as much money as we did now floating around in the world. The money supply that the Fed has pumped into the markets. And I say the markets, primarily the stock market, who's benefiting from the money supply? It's corporations and the wealth that produces from earnings. And you can see on this chart, look at that money printing cycle that we went through because of also COVID, but what Trump and Biden did with their policies. Not to get too political, but they've inflated the markets, and
Right.
we saw that with inflation, and now we're seeing it with the market. So that's the major difference between now and 99. 99, it was a casino. These companies weren't making money. Now we have companies that are changing the way we live with AI and the semiconductor revolution. You saw Apple a week ago talk about their new phones. They're going to have to make all new hardware products. You know how many beneficiaries are going to be created because of Apple having to produce all new phones and computers? Like, think about like ARM as a
The
semiconductor.
suppliers, yeah, the suppliers.
Yeah, the suppliers. Like, everyone's going to be. That's just one thing. So yes, I'm bullish. I'm cautiously bullish. We're extended, but in the long term, unless there's like a meteor that hits or something bad happens, God forbid, a war or something. I mean, I'm pumping my money in right now. I'm full tilt, and the price action in the market's telling me that.
So my next question, the same question I asked those guys, Ted and Connor, what would change your mind to where the market is telling you it is more bearish now? It's not working. What's your biggest indicator?
Are you asking me?
Yes. Sorry. Yes.
Oh, I'm sorry. I thought you were asking Ted and Connor.
No.
My biggest indicator, as far as like technical speaking, I would say
Yes.
break of the 50-day. If the S&P and the Nasdaq start breaking their 50-day, that's like the guardrail. That's always what I've used. That's a basic Can-Slim O'Neill principle. And then leaders like Connor and Ted had mentioned before. If NVIDIA starts breaking the 50-day, or any of these other leaders like VRT or ARM or MU, if those start to crack, Microsoft, if those big names start to break the 50, then I'll probably pull back and see what's going on. And if there's another sector that pops up, maybe I'll get into there. But that'd be a problem, and that would be my number one indicator.
Yeah, if the big tech companies start to go, Microsoft, Apple, and NVIDIA, folks, Katie, bar the door. We're in trouble. You better get defensive. Okay. So in a nutshell, I'm going to put my Dan interpreter on and kind of wrap up in a bow what these technical guys said is basically they're all three bullish. The markets are still in a primary uptrend. We've gotten a little bit choppy the last few days, and it may be just consolidated sideways consolidation. So they're kind of pausing on new buys to let the market determine whether this is going to break out or not, or whether it's going to pull back. If it pulls back to some certain levels, then we buy at those levels. If it breaks those levels, we may get more defensive. Right now, we're cautiously optimistic. So short term, it looks like it's pullback. Mid and long term are still very bullish. All right. With that, I want to go around the room and I want to give each one of these guys a few minutes to talk about their three really best ideas or favorite ideas or ideas they're bird dogging that they either may, and it can be long or short. You can either talk about what you're thinking about is breaking down or what you think about is really about to run, and a couple individual names that you guys are really excited about. Ted, we'll keep in the same order. Ted, we'll go with you first.
The first name I want to talk about that we own and grow and we've owned for a while and have a pretty decent profit on is Kava. We bought it on this downtrend line break and it's up over 40% here. Recent price action to me shows, for example, this outside reversal, we might need to start forming a new base. So you can see this weekly IPO based breakout. We've ran for a little bit now. So seeing some back and fill action, maybe something like this, just build a few weeks, maybe a 2-3 month base. That is what I'm looking for in this Kava name. And I thoroughly enjoy the food. I've been consuming Kava for the last 2-3 years. In college, it was one of my go-to places in terms of
you're supporting their
quote
stock.
unquote healthy. Yeah. In terms of quote unquote healthier fast food. So this is the first name that I'm looking at. And you got the earnings 700% year over year, 28% sales. So, and you see 2024 estimates are really high. So maybe people like me are consuming more and more Kava every week. And yeah, this is definitely a name that I'm interested in. The second one we also own in Grotection is TMDX. I've talked about this. I just thought this was a great name, and Alex gave a great presentation on this over a year ago. So some nice foresight from him there. But we broke out this 9-month base on earnings and just extraordinary numbers, 538% year over year growth, revenues 133%. And essentially they just have this organ care system that allows people to transport organs in a more efficient way to keep these organs healthy for the transplants. And when we ran up here, we actually hit. Sorry, Dad.
I was going to say, does that look like a bull flag? That's what's going to be my question, but go ahead.
Exactly. I was going to get, yep. From this level to about this level, we ran 100%, and then we pulled back only 12% to this level. And so this is a textbook O'Neill high tight flag forming now. We just need to see this tighten up just a little bit more under this 150 level. We're still seeing some sellers come in at 150. But if we can really take out this 150 level, I'm really optimistic about this company. And if you look right here, Market Surge from Market Smith, they kind of transitioned to this new brand and implemented some new features. This little black speck here, let me just refresh the page. This little black speck here, that indicates Market Wizard David Ryan's ANT indicator. And what that is it's 12 out of 15 days up with a 20% plus increase in price, and then overall a 20% plus increase in volume. And when that hits, that just shows that institutions are loading this thing or accumulating the stock. And the high tight flag price action plus the earnings gap just clearly paint that picture. And then finally, I'll go with GEV. We recently added here. We tried breaking out, but kind of struggled around this 183 level so far. But all of us are really into the power generation names. As you can see, 2024 and 2025 estimates are just enormous. We know that with the build out of data centers to power generative AI, it requires immense amounts of electricity, power, and we're going to need to figure out a way to generate all of that electricity to train our AI models and really just build out this revolution that we're in. So yeah, those are 3 names, Dan.
All right, I appreciate it. All right, Connor, what do you got?
Yeah, so first of all, I like all the names that Ted mentioned. Those are some of the top names on my watch list as well. But first name is going to be SMCI. So yeah, everyone knows SMCI. This was the high flyer earlier in the year and had a fantastic move, and it pulled back, and now it's starting to come out of this double bottom base. And what I like about it here is the averages are finally starting to slope back up. Put in that double bottom base. It got above the 50-day last week on a pocket pivot, and it followed through yesterday, but a lot of the tech names came back in. But today it's putting in a nice candle here off that Power 3 setup, and it's one of my favorite setups is, when the moving averages get super clumped together, it definitely means a move is coiling in the stock. And on the other side of that, it lets you manage risk in a great way, right? Because if it breaks those averages, that should be a strong support. So if it breaks that, you kind of know that you're wrong quick. And this one's reclaiming 900 level today. And if you go on the weekly, it held the 20-week, and Alex brought this up on a call a couple weeks back about how most leaders hold the 20-week on their run, and this undercut and reclaimed the 20-week. And if you go back and study a fair amount of leading stocks from the past, most and the indexes often respect the 20-week moving average. So that was a key thing that it did, and plus the volume in the base on that pocket pivot last weekend. That's another key tell is when you see a big surge in volume in the base, and it followed through. Now it's coming back in. So like how this one's acting. Amazon's the second one. This is kind of a name that's just in a base. It hasn't really broken out yet, but when you look at all the other Mag 7 names, they've been breaking out, and this one is setting up a nice VCP out of this base. And you can see the pullbacks continue to get tighter. and it's contracting with that volume as it right on the right side of the bases, which is what you want to see. And with Amazon, they had some news this morning with AI and the Alexa, and how they have a price hike for that service as well. But overall, I think when this one breaks out, it could be a nice move, because look at, Google, Apple, Microsoft, all those big tech names, when they broke out, they saw a lot of buying and a lot of volume. And another aspect is with these big names, they're so easy for institutions to get in and out. And with the index being so heavily weighted in these, if they're going up, most big institutions are going to want to own them to keep up with the index. And then the last one, I'm actually going to go with the sector ETF, LABU. Ted, you can just pull up XBI. But this fits into what I was talking about, is, are we going to see sector rotation? And this is still in the stage 1 base, has not broken out yet. And it's that 100 spot is the breakout level that I'd like to see. But if you go on the daily, this showed great RS yesterday. Wedge pop back above the moving averages, and that RS line starting to hook back. And today it's falling through to the upside. LABU is up around 7% today. And yeah, this is this area of the market that I'm watching, and LABU is a good way to play it. It's got a lot of volatility, a lot of range, so you always have to be aware when calculating your sizes for those type of things.
So you're looking for a stage.
So, yeah.
You're waiting for it to go into stage 2, right?
Yeah, I'm looking for that.
Okay. All right. Well, I appreciate that. All right, let's go to Alex the Greek. Alex, what are your thoughts? What are your favorite 3?
Well, those were good names. Those 6 they just gave are solid.
Did they just steal all your thunder?
No. I'm just complimenting. They did. I think those were solid ideas and good analysis. One of them, mine's probably going to be a little surprising. It's not a high flying like tech stock, but I've owned it, and it's been one of my best names this year. Is Costco. It's extended. I don't think it's buyable up here, but if it digests again, maybe I'll add to it. This one's been really solid. When I hooked up back around 740, I was buying stock, and I sold half of it a couple of days ago. I had to lock in some gains, but I'm holding the other half. And, this is a cash cow, man. That company, that's a well-run company, and I know the employees like to work there, so that's a good sign too. So good management. My other name is Pinterest, P-I-N-S, Pins. This one's a kind of a comeback story. If you pull up like a big weekly or monthly chart, you can see this one was a lot higher previously. I think the overhead is gone now. That was years ago. So I think those buyers and sellers are out, and it's in a new uptrend. And the numbers on the left there, the growth numbers are really solid. I think they found their way on how to make money with their advertising business. And I like to look at this chart. I like how tight it's gotten on the weekly and daily. It's pretty smooth. I like stocks that don't have too big of ATRs where it really hurts on the down days. That doesn't feel too good. So I've been trying to flirt with stocks that are a little bit quieter, and that's given me the ability to sit a little bit better. The last one is a name that
hang on. That looks like it also has a bear flag, a little bit.
Bull flag.
Bull flag, not.
I hope it's not a bear flag.
Yeah, no, bull flag. Actually, it was on the weekly to look more, but yeah, there it is, right there.
Yeah, no, I see what you're talking about. Yeah, that one looks good, and the RS line's pretty solid. So maybe that breaks out another leg higher if the market turns back up. But my lost my train of thought. My last name, what was my last name going to be, Dan?
I don't know. I'm sorry. I didn't mean to rattle your concentration.
Oh, yes, I got it. My last name is a name I've mentioned here years ago. I mentioned it on a podcast. Is Dutch Brothers.
Wow.
I haven't given up on this name. I mean, I've tried this name. I got to be honest. I've never made money on it. I've lost like 15 times I've tried it, but I have gotten in, and I am up on it a little bit. So it is starting to look like it actually may find its footing. And I think part of the issue is the institutions didn't trust it. I think that we need some flag funds to get in there. actually, Ted, can you on the right side pull up the funds that are, yeah. So, okay, this is a good sign. So MarketSmith has a way of like flagging the top institutional mutual funds or what have you, and that's got 3. So it didn't have that previously. So that's telling me that some big buyers are starting to show interest in it, and I think that this might have a chance of actually working this time. So 16th time is a charm. Give it a chance. But I like this name. I know the story. I've been going to Dutch Brothers since I was in college, like 14 years ago. And there are always those lines on the door. So I'm just waiting for the stock to cooperate with the story. So maybe it does. That's my last.
Yeah, and in fairness, you've always kept your losses small. So as long as you keep the losses small, you let your winners run.
Exactly.
Yeah.
I mean, if I get a 40% gain or so, I'll be way in the green. I've taken 2-3% losses. That hasn't been bad. I'm actually curious, Dan, what's your stock pick? Like, what are you looking at? We never asked you what stock you're looking at.
Wow. I actually look, because everybody's focused on NVIDIA, I've been following NVIDIA, Microsoft, and now Apple's actually heated up just recently. It hadn't been for a while, but now Apple's looking better and better after that, after their earnings and their iPhone announcement. Again, though, because that's where all the money is right now, and I think the market, the total market, even the other leading stocks, are really going to be affected by those big 3: Apple, Microsoft, and NVIDIA. I mean, I hate to say it, but even if you've got a good pick, whether it's Bros or whether it's some of these other names, right? If NVIDIA and Microsoft start to break, Katie bar the door, the market's going to get broken. I mean, I hate to say that. That's why it's so important. And that's why, the other day I said, are you in the right narrow? The show a couple weeks ago, the whole thing was, are you in the right narrow? This is a narrow market. There's lots of places in the market that are not making money. So the question is, why are you there? If you've got a way to measure it, see, I think you're actually reducing risk by having less diversification as long as you have a sell discipline. So as long as those things get taken out when they break down, it's okay to be in 3 or 4 sectors that are working and avoid the sectors that are not working. And as soon as the sectors you're in start not to work, start taking money off the table, sell a third or a half. And if they continue to not work, then you just get out. That's the way that we manage risk here, not by having some big, broad diversification. Look, if you've got that 60-40 pie chart, okay, in 2022, your bonds got slaughtered, right? Didn't work. And stocks got down too. Bear market, you were down. This year, you've got international that's not doing well. You've got small cap. You got all this stuff. Only your large caps in your big diversified portfolio. I've seen lots of people come to me with, they want a complimentary portfolio review, and they've got a diversified pie chart literally at like U.S. Bank Corp, at Morgan Stanley Wealth Management, all these big full retail brokerage firms, and they've got and they're up like 5% for the year, or 6-7%. Folks, the S&P's up what, 13, 14, guys? I mean, we're doing a little better than that, but it doesn't matter. All I'm saying
is, wait, like you reaffirmed your point.
Yeah, and but if you've got that diversified portfolio, so if the S&P's up, let's just call it 14, that means that if you're up 7 or 8, that means you got some stuff that's negative or up 1% or 2% or 3%. Question is why? Why? If you can have a sell discipline. That's what I mean, and that's why I'm going back to it. I believe it's a loser's game, whether you're diversified or narrow, if you're losing money or it's not working. It's okay to have a pullback or a drawdown of your portfolio as long as you quickly put a tourniquet on it, wait for the next cycle up, and then get back in. If you manage your drawdowns, when the market starts behaving again, you compound from a higher base. That's so important. Okay, I do have one more mailbag. I do want to read these other 2 mailbags because I did get these, and these are kind of related. Good morning, Revere team. Hope you enjoyed the Tesla annual meeting AI makes progress, as Lonnie confirmed. They have 2 Optimus bots working at the Fremont factory, plan to have over 1,000 by the end of the year. Well, lots of discussion on autonomous vehicles driving future valuation. The future is coming very fast. FYI, do you get this email from Beth? It's a email from them putting out stuff. Want to ensure that you have the info as it discusses coin and IBIT. Take good care. GJ, excuse me. Thanks for sending. Good speaking to you regarding Tesla. Now that the shareholders meeting is over and they've approved Elon's pay package, let's see if they deliver. I will include in the mailbag so we can both touch on Tesla, coin, and hood, because they're great topics. So, Ted, why don't you bring up those 3, and why don't you guys kind of discuss those 3? What Tesla, coin, and hood look like at the moment.
Okay, I can discuss Tesla, and then Connor, you want to do coin, and then Alex, you want to do hood. So
There you go.
we just all have, yeah, I think that's a good way to divvy it up. So yeah, Tesla, with Elon Musk receiving his pay package, many investors are excited, obviously, because he's the machine. He's the CEO driving a lot of the innovation and execution in the product. But for me personally, and I just have to make it clear, at Revere, we're not buy and hold long-term investors, we're trend followers. And what that means is we want to see an established trend. Usually it's above all key moving averages, where the momentum's the highest and where we know institutions are accumulating and bidding up the stock. Right now, we're still below a declining 200. And I'll quickly highlight what I do want to see. And I'll go back to, let's say, 2020 on a daily chart. I'll go back a little bit further, actually. So here, this earnings gap was a huge surprise, and I believe Alex traded this entire move. So that was an amazing trade from Alex, and if he wants to talk about that after me, he can. And what happened was a huge earnings surprise, which made the stock gap up 18% of 300% volume out of this huge neglected range by going a weekly. Tesla essentially has been going sideways for more or less 5 years. And this surprise really catalyzed this subsequent move. And we got above the 200, which is the black line, and the other key moving averages, the 8, the 21, and the 50 started sloping up, or were sloping up, and crossed above the 200-day moving average with bullish alignment. And I'll just go to 2021 so I can highlight the move. This was the 2019 gap up, and this was the ensuing move that happened because of it. As you can see, this move happened above all key moving averages. And as a trend follower, that is what I'm looking for. And I want to see a stock in an uptrend. And I'll go back to today. Reset to today. As you can see, we've been just in a downtrend and below all key moving averages. So there's really no fear of missing out if institutions believe that Elon Musk and Tesla and the team will execute on their vision of the humanoid robots and the robo-taxis and revolutionizing that world. We will see the stock get above 200 and the 200-day. And we will get on when there's a setup. And that's the key. And like Alex said with Bros, the story may be great, but we need the stock to act right. And I guess a great paradox or truth that you should be aware of is that a good stock or a good company does not necessarily equal a good stock. And at the same time, a bad company could be extremely good stock in terms of performance.
Making money, yes. Yes. Well, a couple of comments. Number one, I think Ted just made up a new word, catalyzed. I'm not sure that's a word, but I love it. I understand exactly what he means. Now, here's the thing that people don't realize and why we're so adamant about we don't buy into that buy and hold strategy. So leading stocks on average fall 72% from their top in a bear market. So Tesla was the stock to own in 2020, 2021. It was the darling. Everybody wanted it. But in 2022, in that bear market, it sold off 69% from the top. So it sold off just 3 points within that Bill O'Neill's average of 72% of leading stocks. And the reason I'm so in tune with the stock and know this, we've got 3 or 4 clients that were former Tesla engineers, and they came on board about 2020, and they worked for Elon for a few years, got some stock options, and it was 70-80% of their portfolio, and they had a lot of money. By the beginning of 2022, we had got them all out between $900 and $1,100 pre-split. And now they're grateful, because if they had bought and hold, if they had gone to an advisor that held their Tesla stock, their net worth would have been cut by 2/3. I'm rounding, but by 60%. Okay, that's why it's important. NVIDIA, don't get too married and fall in love with NVIDIA. It could have the same outcome at some point. Actually, it will have a massive sell-off at some point. We're not there right now. Could be next week, next month, or next year. I don't know, but I'll know it. I'll see it when I see it on the chart. I'll know it. Alex, did you want to chime in and talk about that monster trade or no?
I mean, if you could change your life if you get into the right name like that. I mean, there's once in a generation type trades like that. I think NVIDIA just offered that. It might be towards the tail end of it.
Right.
But Tesla and NVIDIA are prime examples of when you see big money and a big stock like that changing the way we live. If you can get you don't have to catch the whole thing. I traded around it a few times, but if you can catch a portion of the middle, you could really improve your portfolio. You don't have to be all in either, like Dan was saying with your risk. I mean, I go riskier because I'm just trading for myself. So I was like 20% long, and that propelled me, and that's when I started to go full time on this job. And it was actually the second run after that dip right there.
Right.
After the COVID crash, I got back in. That was the run. That second run is the one I made a good portion of money. So I really didn't make money again on it. It's been in timeout, and maybe like Ted was just saying with the robots, and they need a new storyline instead of cars. So that stock could come back. We've seen it. Listen, everyone gave up on Microsoft, said it was an old dog.
Yeah.
Microsoft ran. Here's a really good example, actually, of old dogs coming back. Pull up GE. GE it's been in the doghouse for 20-something years. My dad worked there for 35 years. Okay, look at the recent run it just went on. It just went up, I think, 200-something% in 2 years. So stocks can, companies can change and develop, and they can have new runs. That's an amazing run right there. And I wasn't watching it because it was an old dog. So Tesla can come back. Maybe later on it has another run.
Yeah. So Microsoft's a perfect example. When who's that guy's name? Ballmer took over. He kept going to the old model, the old floppy, their old software, and they weren't going to the subscription model, and they weren't keeping up with technology. And it was it was dead money for 16 years. And then Nadella took over and changed that whole thing, and Microsoft became a market leader again. So when I see these articles, this dividend stock, you can stick it in your drawer and forget about it, I just laugh. That's a ridiculous statement. It's stupid. If you hear anybody tell you can buy that stock and stick it in your dresser drawer or hold it for life or hold it forever, run fast. Okay, that's a surefire way of getting creamed. And the last point is, just because a stock was a market leader in the last cycle, it doesn't necessarily mean it'll be a market leader in this cycle. Now, most good stocks like Cisco Systems in the 90s was a market leader through 3 or 4 cycles. But then after the tech wreck, it wasn't a leader and hasn't been since. It just isn't. It's a commodity now. Microsoft wasn't a leader for 16 years, but then it came back. So that's why you have to have rules to help you determine what is a leader and what isn't a leader without your emotional bias, like Bros or like GE that Alex was talking about. Hell, even professionals, it gets in our heads. There's a whole industry of finance part called behavioral finance that is just about why people make irrational, dumb decisions given the facts. Why do they still act emotionally? So even professionals do it. We try to use rules to make us step out of our emotions and our feelings and help us define risk and make it as unemotional as possible. In fact, that's one reason Don is good at what he does. That's what makes him so good. He's like a damn surgeon. He just goes in there and broke the rule, we're out. Nope, we're not going to debate it, right? He is very, very systematic. So it works very, very well. All right, who is next? Is it Connor's turn now?
Yep.
All right, Connor.
I'll talk about coin. So yeah, this is a name I've followed for a while, traded it like at least 4 or 5 times in this, and just zooming out, that move out of that stage 1 base was fantastic. Then it came back and retested that base and had another nice move this year. And I like how it's setting up on the daily right now. It held that 20-week moving average, which I talked about is a good spot that leaders will respect when they're running. But it needs Bitcoin behind its back to really get going. Bitcoin's been struggling. It's been pulling back, and I view Coinbase as a levered Bitcoin play. Although the correlations are always changing. You'll see Coinbase down when Bitcoin's up, or sometimes you see vice versa. But overall, Coinbase is usually trending when Bitcoin is trending as well. But right now, I don't love that 50-day is starting to roll over a bit. But bigger picture, to me, this just looks like it's setting up a big base, because it has run from, $50, $50, $60 all the way to $225 in a short period of time. It's still trading below that IPO price. So there is still some overhead resistance, but based on how it's been acting recently, I don't see why not. It could take a shot at those highs and clear into all-time highs. So that's, that might be a reason why it's finding some sellers around here, just with that supply. It IPO'd in a hot market, so I'm sure a lot of people bought that, and maybe they're trying to get break even finally now. But earnings are fantastic. Coinbase is, from what I've looked into it, I don't use it, but it's the easiest way to buy crypto versus all those unregulated exchanges and whatnot. And yes, so I think as long as it's holding above that 20-week and 200 level, big picture, it looks great. I would like to see it tighten up on the right side and that 50-day to hook back up to buy back into it. But yeah, this one always stays on my watch list, and I'm always waiting for it to set up because it has a great range and it can trend really nice. You look at the last 2 runs it had, those are like 80 to 100% moves in a few weeks. So definitely on the radar for sure.
All right. So, Alex, we'll go to you, and you can take Hood, Alex.
So, I mean, looking at the daily, this chart looks fantastic. I drew some Fibonacci retracements from the high of 85 down to 681. There's a fib above that's at 25, 26. So maybe it can get back up into there and then rest. Fibs are really good levels that I use to help gauge price action probability. You can look at this up on yourself. I don't want to get too nerdy here, but they've worked for me in the past on pullbacks and where a stock might go. It gives you a framework of a vision of where the stock can work. But right now it's holding the 21 EMA. I don't see anything really wrong with it. It just pulled back from 24. I mean, if the market wasn't so extended, I'd probably take a swing at it, but I'm not, because I think I have enough exposure right now. But it does look good. Yeah, it is on my watch list, that name.
Okay. All right. So those 3. So we hit that one. So I've got one last mailbag. Kind of toot our own horn a little bit. This is on 619 from TT. Hey, I'm so happy to have y'all investing for me. You're blowing me away. One question, though. I recently surpassed a certain level, mostly because of y'all, because we grew the money. Do I go to another commission level? Don, you rock. Dan, you roll. Ooh, Dan and Don, rock and roll. Anyway, me, that's awesome. But please don't call it a commission, because we don't work that way, because it's your money, not their money. See how I did that so I could work it into the show notes? I even put that in the email. I will have Merrill load up a new agreement. We can change it starting the beginning of next quarter. Thanks for the kind words. Folks, I wanted to be fully transparent and talk about the fees, not just the portfolios and what we're doing in the portfolios. So at Revere, there are no other fees. There's no commissions. There's no loads, no 12B1 fees, if that's still a thing. I've been out there. I've been away from the commission side so long. I don't know what they call the terminology, the broker salesman fees, loads, and how they're classified. Okay. Now at Schwab or the brokers, wherever you are, they're selling the order flow to the exchanges via free trades. Okay. So now you may be paying $2 or $10 for execution. You don't really know, because they don't have to guarantee best execution. When they were charging you $4.95, they had to guarantee you best execution. I'd rather pay the $4.95 and get best execution than having to audit them every week. However, so it's not so true story. When I got audited this last time, the SEC regulator looked at me and said, "Hey, how do you ensure best execution? Are you auditing the trades that come through and compare it to the tape, to the actual trades coming through the exchange, and kind of comparing and making sure that you're getting best execution? How are you ensuring best execution for your clients?" And I looked him right in the eye and I said, "You mean ever since the SEC allowed Schwab and the others to give free trades away, and now you don't know what their rate is, and now you don't know?" I would have rather paid the $4.95 and knew I'd get best execution. He looked at me and smiled and said, "Well, we did do that, and yeah, it did, but still, you're required to ensure best execution for your clients. So I'm going to ask you again, how do you do that?" And I said, "Well, we don't have to wait for the month. We're using 2 or 3 different trading platforms. We're looking at live, real-time trading levels, all that kind of stuff, right? We know before we pull the trade, we know the volume, the daily volume, the current volume that day, intraday, and we know, can we use a market order? Do we have to break it up into a trade or two? Do we want to use a VWAP, volume weighted average price, a limit order, however, right? And as soon as we put that trade in, if we get a bad fill, I'm on the phone to Schwab bitching, saying, "Hey, what's going on? We want a price improvement." Now, that happens very infrequently, but I told the regulator, I call him on the mat right away. And he said, "Well, man, you need to add that in your ADV and the company brochure, because clients need to know that." But I'm glad you're doing more than 99% of most what other advisors do. Most other advisors kind of audit at the end of the month, not in real time as it's happening. Okay. So in any event, the only fees you have at Revere are the management fees, and then you've got the order flow at Schwab, and that's it. Now, we're not necessarily trying to be cheaper. We're just trying to be transparent. Now, the reason I wanted to brought up that he's a client and he was asking me, "Look, I hit this next level, so I hit the break point of your management fee structure. Will you redo it for me?" The answer is yes. However, I actually have to get a new management agreement updated and signed. Why is that? It's a violation if I undercharge you just as much as if I overcharge you. See, the regulators don't care whether I over or undercharge you. They just want to make sure whatever I charge you matches what's on the management agreement. So again, folks, we are the most transparent advisor out there that I'm aware of. We do a daily market video every night the market's open, so that you can kind of see in real time. And by the way, once you become a client, that newsletter really comes alive, because now instead of kind of, it's kind of out there esoteric in cyberspace, kind of out there in the internet ether, and you can't really feel it or sink your teeth into it. When you become a client, now it becomes living and breathing. And what we're saying on our video, you actually feel in real time. Okay, folks, before I go, guys, do you guys have anything else? Anybody want to add anything else? Nope. You can say no. You don't have to be silent. Nothing like on a podcast when you have dead silence.
I
Ed,
think
you
we're
got anything
muted.
else? Huh?
Nope.
All right. All right, folks, listen, please, if you like what you heard, please tell a friend, tell a neighbor. We very rarely advertise. We're growing very rapidly, and that's because of you. That's because of you and your money. You trust us with your money, and you tell people about us. We grow by word of mouth. Just tell them to go to revereasset.com. Go in the upper right-hand corner. There's a subscribe button. They can put their name and email address in, and then they can get our daily market insight video newsletter every day the market's open, delivered right to them. They'll get this podcast on Saturday morning, and they can decide for themselves whether they like what we're talking about. Alternatively, if you go to YouTube and just search for Revere Asset, this Revere Asset, and you subscribe there, Zach, our producer, will have this show out by 1 o'clock Central Time. So for the hardcore stock nerds, they'll get it before the close on Friday. Otherwise, if you go through our newsletter, they're not mutually exclusive. You could do both. If they go through our newsletter, it'll be there Saturday morning. And you can always, folks, email any of us, Dan@revereasset.com, Don@revereasset.com, Ted or Connor at revereasset.com. And you can always call us old school at 855-REAL-WEALTH. Folks, have a happy and safe weekend, and we'll talk to you next week on Their Money, Not Your Money. Because like God says, it's not what you make in the markets, it's what you can keep.